From Washington, this is the Macrocast, a podcast brought to you by Penta and Markets Policy Partners.
Good morning. It's Friday, October 7th, and you're listening to the Penta Macrocast. I'm Matt McDonald in for Tony Fratto this week. I'm here with John Fagan from Markets Policy Partners. It's Jobs Day. It is a skeleton crew Macrocast here before the 3-day weekend. Tony is
do our best.
Tony is off at Pitt at a board meeting. Where's Brendan? He's out of the country.
Mexico City. Some meetings in Mexico City.
Well, jobs don't wait for the Macrocast, so we will press on. Over to you, Matt, to give the headline numbers. Thank you, Matt. Okay, we've got the jobs numbers this week was 263,000 new jobs. Unemployment went down to 3.5%. A couple of pieces under the hood. Labor force declined, which is not great. That was down 57,000. Interestingly, a lot of the job gains, 263 is thousand, I feel like is a, normal jobs number for normal times kind of thing, even though that's not what we're living through. But big gains were driven by leisure and hospitality and healthcare, kind of the two sectors that were hard hit by the pandemic continuing to heal. Healthcare is now fully recovered to pre-pandemic levels. Leisure and hospitality is actually still off. Hourly wage gains continued upward, 0.3% on the month, 5% year over year. John, we also had JOLTS numbers this week, ADP numbers. There's been a lot of jobs data this week. I would say that the actual jobs report is probably cold comfort compared to where the Fed would like to see it land. What's your take, John?
Yeah, certainly this is not a Goldilocks report from the perspective of the Fed. It is, it's a strong labor market. It's a strong non-farm payroll report, and the brisk average hourly earnings decline in unemployment rate. I think the decline in unemployment rate is probably the one that's getting the most reaction out of the markets.
Yeah, if we saw more gains in the labor force with the same headline numbers, I think it would be fine. But this all points toward continued labor market pressure that based off Fed signals, doesn't point away from another 75 basis point hike.
Yeah, that's right. And Federal Reserve officials have been out this week and really hammering on the hawkish message again. And I think that there was coming into this number, we did have some lead up with some varied and divergent kind of signals from the jobs market. Now, obviously with the caveat that most labor market data tends to be among the most backward looking of macro indicators, which we said before. Yeah. But the week kicked off on Tuesday, which seems like quite a while ago at this point, with a very eye-popping decline in job openings. The job openings and labor turnover survey, JOLTS, gave the markets a jolt, and a positive one. And it was, just to go back and look at it, it was a 1.1 million decline in the number of U.S. job openings to 10.1 million in August. That's the lowest level since June of 2021. So it's not exactly and it's coming off, a very high, and I think record levels of 11.9 million back in March. And so it's not that far off record levels.
Yeah, it's but super interesting.
Like a notable shift.
It's super interesting, your point on which of these indicators are backward looking, which of these indicators are forward looking. We have a lot of lag effects in Fed policy itself. I mean, the JOLTS has a quality of kind of like jobs that companies couldn't fill to begin with. And maybe they're like, well, the economic forecast is, more uncertain. So I'm just going to close this job opening. Meta made headlines with I don't know if it was rescinding offers for the interns or something like that. I mean, tech has been leading the way on some of the hawkish approach to the labor market over time. But the forward-looking signals and the backward-looking signals it's pointing in kind of different directions.
Yeah, that's right. And really, the very next day after the JOLTS data came the ADP, that privately, the payrolls giant, that privately compiled version of the non-farm payrolls, which is sort of notorious for giving traders false signals, but not this time. It was really on the screws with expectations on the slightly strong side of expectations at 200 plus K new jobs, consistent with what the message that we saw from this non-farm payrolls number for September. And, the more high frequency one came in on Thursday. It's that weekly jobless benefits, which ticked up a little bit higher than expected. But again, we're talking about very low levels, and the trend which we'd seen sort of developing over the spring and summer of rising unemployment benefits, which would suggest a softening in the labor market, has sort of come into a bit of a choppy sideways and less clearly trending motif here. So, there's nothing here. The Fed had really the bit between its teeth when it came to when it comes to tightening, and there's nothing in here to rein them in. Absolutely, the as you said, Matt, the opposite is to be true. This is going to this is going to solidify their hawkish intent here. But we do have some really big numbers next week, and we can talk about that. But essentially, drum roll, please. It's another CPI number. Oh no.
Yeah.
and the PPI data. So, everything we're saying now is subject to change on the basis of that particular number.
Yeah. It is. I mean, the one thing I would say as an interesting indicator within the jobs number, despite the kind of 263 being a solid number for a normal time. And I do think the labor force drop is like the real red flag in this whole exercise. I mentioned leisure and hospitality and healthcare. Those sectors combined in this whole number was 143,000. So you kind of, if you X that out of the 263 headline, you're kind of at 100 and change outside of these kind of pandemic healing sides of things. So it'll be interesting to see where the coming months land on some of this stuff. But, as we kind of progress towards the back end of the labor disruption of the pandemic and all that sort of stuff, some of the stuff may normalize. I do think that, we went through this exercise during the financial crisis and the years after that, is that the healing of that took so long that some of the big demographic shifts in like baby boomer retirement and that sort of stuff actually changed the denominator of the jobs like recovery over time. And it feels like we're getting a little bit of that with the pandemic, is that, you start to get several years out of it, and the aging of the workforce and stuff starts to kick in, and there's just you're kind of you're solving against a different labor force over time, which is interesting.
Absolutely, and estimates for sort of missing immigrants, the immigration that and
yes.
migration didn't occur has been a factor that people have pointed to as well. Yeah. The difficulties of women in particular getting back into the workforce at a time when you have lots of, you still have lots of uncertainties around the health situation and the situation in schools and care for relatives and these kind of, demands around the home. It's an unprecedented labor situation. The Fed is looking at it through an inflationary lens, and this still looks like an inflationary and tight job market, despite all these factors. We are going to get, and we have heard this drumbeat of more corporate management coming out and saying, we're battening down the hatches for some challenging and choppy weather ahead. 2023, a lot of companies have sort of pulled their guidance. We've been hearing some high profile, not necessarily big layoffs, although some of that is filtering through, but hiring freezes and so forth. Yeah. Facebook was very prominent. Meta. Very prominent in
don't
that.
Knock the rebrand, John. Come on. Right. Everybody needs a freshen up from time to time.
That's true. So earnings season, actually third quarter earnings reporting starts next week. So next week is a humongous macro week, and with CPI, PPI, with the Fed minutes of September coming out, and with earnings, it kicks off with mega banks, but eventually, in the ensuing weeks, we'll get into these the industrials and retail. And they're going to have a lot to say on the subject. We heard, FedEx management coming out and sort of preemptively, giving their sort of off. They've got sort of an off fiscal year, so their earnings are a little bit out of phase. And it was very dismal listening to their CEO forecasting a worldwide recession in the coming year.
There's a CEO survey that came out. I guess it was this week that upward of 80% of global CEOs anticipate a recession. I mean, that's where kind of the planning is. So I don't know, even if the job market may not have gotten the cue from the Fed, the CEOs of companies certainly seem to have. It all kind of begs the question of how you kind of manage all of this and how you land the plane in terms of, expectations of the economy are shifting, which we've talked about the importance of expectations in the inflation management game. But you still have kind of the momentum of the job market. And obviously, like, the Fed has gone out of their way to say that they're not trying to cause a recession, but they've also been pretty clear that inflation is priority 1, 2, and 3. And if things go a little rough on the back end, so be it.
Yeah, and we've seen that commentary really be redoubled this week. It was last night. It was Governor Waller, and we've just seen a parade of Fed speakers, even some of the relatively dovish officials like Chicago Fed President Evans and San Francisco Fed President Daly, really pushing on, that the work isn't done and inflation is nowhere near where they need it to be, and tightening is going to continue. Interestingly enough, just in the nuances, they've begun to focus a lot on 2023 and talking about how they are, that rate cuts are, do not expect rate cuts in 2023, which is what the futures market is expecting.
Yeah.
And so when the futures market has the, rates going up to sort of 4.5%, and then coming back down and starting cuts in summer, as early as the summer, that's essentially an affront to the Fed. It's saying that they're going. The Fed is taking a very powerful line against this, against the way the market's positioning on this.
Yeah, I don't know if I buy the Fed line on that. I feel like that is tomorrow is tomorrow. I feel like they're definitely focused on reestablishing Fed credibility. But if inflation is back under control and they get that done, and then the economy is sucking wind, I don't see a scenario where they stay at high interest rates out of principle. I don't know. I'm not.
I mean, the other thing that Fed speakers have had to address is the financial market disorder, and they haven't really addressed. And they've addressed it by not addressing it, essentially, and saying nothing to see here. The U.S. markets look fine, and it's not the U.S. markets where the disorder is. It's of course in Credit Suisse. It's in the UK. The parade of governments that have had to intervene since the Fed September meeting to steady their currencies. That's not a coincidence that all of those intervention efforts followed that September decision, which redoubled the hawkishness of the Fed. You're getting Treasury Secretary Yellen came out with a speech yesterday that basically said, policymakers have to keep forging ahead to suppress inflation, but they have to do so with sensitivity toward the spillover effects. And she knows something about that. She was, she started her hiking cycle in late 2015 and then had to put it on hold for a year.
I would even argue just to modify that sure, spillover effects are bad, but it's actually the feedback loop that's actually the thing to really focus in on. I mean, the Fed, look, for fundamental purposes, the Fed's responsibility is the U.S. economy, and they have to get inflation under control. And I get all that. They want to be mindful to the extent that they can of those spillover effects on the rest of the world, and that is true. But even more relevant is in a interconnected global economy, to the extent that the Fed's impact of the Fed policy on other economies is detrimental, and then those economies in turn result in a drag on the U.S. economy. That's that's a feedback cycle that, on some level leads to the kind of inflationary, de-inflationary or de-escalation of inflationary impact that the Fed is looking for, right? But that's a hard thing to measure and hard to kind of like, again, with all the lag effects in place with all this stuff, it's very difficult to actually do in a measured way.
Yeah, and by going at a completely breakneck pace, irregardless and heedless of the spillover effects, and just as you say, the feedback loop.
If you're going to say irregardless, you have to say it with a heavy Boston accent, though.
my Boston accent can definitely reemerge at strategic times, usually after I've had a few cold ones.
Let's talk about while we're on the subject of global, I do want to talk about OPEC. Let's take a quick break and come back and talk about the energy markets, which have, are clearly tied into a lot of the geopolitics and a lot of the inflationary cycles that we're seeing. This is the Macrocast. We'll be back.
Every 2 weeks, Penta measures U.S. adults' feelings and expectations toward the economy. The Civic Science Economic Sentiment Index, powered by Penta, accurately measures movements in overall national economic sentiment and provides a more sophisticated alternative to existing economic sentiment indices. To learn more, contact us at pentagroup.co.
Welcome back to the Macrocast. Matt McDonald here with John Fagan and nobody else on this holiday Friday, but we're powering on, delivering the insights and news that everybody counts on us for. John, hit me on energy markets and OPEC and what went down this week.
Yeah, we've seen, so just to set the scene, energy markets have been extremely choppy this year. We've seen the big peaks and spikes in natural gas futures, particularly in the EU, because of everything that's happening with Russia weaponizing supply, has traded like a cryptocurrency and not a good cryptocurrency at that. And that has obviously had some gravitational pull on crude markets. Oil prices skied up, and you got Brent, knocking on the door of $140 a barrel over the sort of spring summer period. Now, things have calmed down considerably. We have experienced a massive level decline. We're down in the mid 90s in Brent, which is not historically cheap by any stretch of the imagination, but certainly represents an enormous downtrend from those peaks from earlier this year. And so this is we're getting into a territory where OPEC had been playing ball, reintroducing and winding up its supply cuts from the COVID era when it curtailed production in order to support prices. And obviously, that policy isn't really fit for purpose now. But they're back this week in the output cutting game. Now, this was forecast and projected pretty clearly by the OPEC ministers talking ahead of the meeting. There was an estimation that about 500,000 barrels was what they would cut, but they progressively over the course of last weekend, the headlines kept upping the ante. It went to 1 million barrels. It went to 1.5 million barrels, and ultimately they cut 2 million barrels. With that kind of aggression, that kind of messaging, you'd think that maybe there was quite a big volatility spike in oil markets, and actually that wasn't the case. We did see Brent rebound, and it is continuing to rebound. It had gone from sort of high 80s, and it's around 95 right now. So obviously on the upside, but not spiking by any stretch of the imagination. And part of that is because there's some ambiguity as to really what this 2 million barrels per day cut means, because they were producing, 3.6 million barrels less than their quota already. And so is this basically just, kind of accepting of reality
yeah.
and going back, and it's really not going to make big, or are they, UAE and Saudi and Russia going to cut on top of, are they going to do the cuts?
This is a really interesting kind of signal versus the noise question altogether. I mean, I don't know. It's very interesting. Like when you think about some of the shifts from pandemic to post-pandemic, when you think about, the Russia-Europe energy situation is centered more around gas than it is around oil. You've got like changing behaviors and changing consumption. You've got supply chain shifts. I mean, it's a very interesting environment. And I do think that there's a little bit of, escalation on the headline of OPEC cuts versus kind of like where this actually lands in terms of the economy. It's an interesting question.
Yeah, it is. And, as you say, the messaging and the substance, the difference between signal and noise, obviously there's a lot of noise around what this means geopolitically. And, the Biden administration was quick to come out and condemn this decision, calling it short-sighted and essentially saying that OPEC is complicit with Russia's weaponization of energy markets. Now, that's not what OPEC said. Of course, their justification was the global economy is careening toward a recession in 2023, and we're back.
They're not the only ones. They're not the only ones noticing that.
I mean, it's
as we've discussed.
Absolutely. And there's certainly a more than a kernel of truth in that. Obviously, they're just joining the ranks of more and more CEOs that are doing exactly, and business leaders and so forth that are doing exactly the same thing. Yeah. But the messaging and like that, you can accomplish things in two ways. Just like the Fed can hit, the Fed can hit 4.5%, whether they do 75 at the next meeting or whether they do 50 and gradually get up there. And in some, in the current case, it may be more likely that they get to 450 if they go slowly. And that's the kind of thing with OPEC, which is, why do 2 million now? Why put that message out there when you are, when it's so tied up with this Russia and this Russian question, and that's the assumption is that the Saudis are trying to send a message to the U.S., which is we're not really on your side on this one.
Yeah, it is. All of this is very interesting when you think about kind of the lag effects, the geopolitics, the different agendas, and that sort of stuff. It all has a quality of like it's a bit of a coordinated game, and whether it's the Fed or the Saudis or what have you, is that big moves in a coordinated game are very difficult. There's some element of if you want to land the plane cleanly on all this stuff, you need to give people time to adjust to different scenarios and kind of like forecast different scenarios and have all the different players change expectations and what in the direction they're going, that sort of thing.
Yeah. And it really is, the lack of coordination on the side of the sort of West. I mean, it's really notable in terms of how, disparate just from the UK to EU to the US, the ways in which, we've sort of grappled and with the inflation problem, it has, seemed more, suboptimally like an every man for himself kind of scenario where everybody's dealing with their own set of problems and not really looking up. And this was,
where's the committee to save the world when you need it? That's what I want to know.
we've got the IMF and World Bank annual meetings next week. And so next week, let's put it all together. US CPI and PPI. And we've got start of earnings, we've got Fed minutes, and we have bank fund. And by the way, the Bank of England's bond buying program, which it needed to bail out its pension system from having a meltdown, winds up on Friday. And one would assume that given the fact that bond markets are back into a little bit of turbulence here, that there is going to have to be some sort of lengthier countermeasure. I assume that the bank fund meetings, which are the first one in person since I guess it would be the fall meetings of 2019. This is the first truly in-person one, and one would assume that we're going to have some very lively conversations. And watch this space. Potentially, this is an opportunity for leaders to come out with a greater, a more shared sense and coordinated sense of purpose against these really big challenges they're facing.
Well, I'm glad. I mean, the silver lining is that the gang will have plenty to talk about when they all return from their various commitments this week. So that's good. What is the date of? Do you know the date of the next Fed meeting? When is that actually happening?
It's like November 2nd or 3rd.
Yeah.
So yeah. So we still got a period of time. We've got some, but between now and then, the Fed messaging seems to be pretty much set, which is we're going to go.
I think that
hammer and tongs. And
and that was the message coming in strong to this jobs report. And with this jobs report landing where it is, it doesn't feel like they're going to be shying away from that at all.
No. And I think that, the next week's CPI really will be a big difference maker potentially. So could change the tone in markets on a dime, truly. But this puts us on another track to 75 basis points. But, between now and then, we're seeing, clearly the reaction, volatility resurgent, the dollar, punching back up toward its multi-decade highs. And, you got to watch the bond markets. And there's now headlines in the EU, of course, about, the credit worthiness of Credit Suisse and some of the other major banks there. That's all we need. Yeah, that's not a pretty picture, and renewed stress in global currency and bond markets between now and then is could be a factor, and we'll see. What we haven't heard, we've heard a lot. We always hear a lot of Fed chatter, but we haven't heard Chair Powell talk about his take on global financial stability and spillover / feedback risks, and so that will be telling.
Yes. All right, that's enough for 1 week, and plenty to come in the weeks ahead. Thanks everybody for tuning into the Macrocast. I'm Matt McDonald with Penta, John Fagan with Markets Policy Partners. Have a great long weekend, everybody.
Thank you for listening to the Macrocast. Please remember to subscribe, rate, and share.